Hello friends, welcome to Wealthy Options. This is Reddy Reddy. In futures and options trading, many times you would have come across words like spot price and strike price. In this video, I am going to explain about what is spot price and what is strike price in detail. Let me explain what is spot price first. A spot price is nothing but a current trading price of an underlying. So what is an underlying? Underlying can be any index like Nifty or stock like a Reliance. So let me take you to the NSE website so we can talk with an example. So in NSE website, so if I can look for Nifty, so the Nifty trading price, the Nifty currently trading at 14,677 rupees 80 paise. This is called spot price. Okay, this is for index Nifty as index underlying. Now let's look at a stock as well. I'm just taking Reliance as an example. So as you could see, Reliance is currently trading at 1937 rupees. So this 1937 is nothing but it's a spot price of a Reliance. Now let me explain what is strike price now. So a strike price, it is price at which you want to buy or sell an underlying when you exercise the option contract. Again, where underlying can be a share like Reliance. Now let's understand this from both investors and traders point of view. So investors basically choose call option strikes depending on at what price they want to buy underlying. And similarly, they choose the put option strikes depending on at what price they want to sell their underlying. And when it comes to traders, so traders choose different strikes to buy or sell options depending on their capital, risk they want to take on the trade, and the probability of winning the trade, etc. Let's go to NSE option chain to understand this with example. So what you see here is the option chain for Reliance May month contract, and all the options on the left side are call options and all the options on right side are put options. So as you could see, there are multiple strike prices available for investors and traders to choose. Now let's understand this first from the investor's point of view. So let's say an investor who wants to buy Reliance at 1940, so by the end of the contract, so he can choose 1940 call option which is trading with premium of 40 rupees 80 paise. Now if the investor is happy to pay slightly higher price, he can choose 1960, 1980 or 2000 rupees. So what is the difference here? So when an investor wants to get a right to buy the stock, in this example Reliance share at 1940, he need to pay a premium of 40 rupees 85. But if he is ready to pay a slightly higher price, he can pay less premium, almost like a 17 rupees less premium per share, and then buy it and get a right to buy it 1980. Similarly, the put option, the investors from the put option point of view, let's say an investor is holding Reliance shares and he wants to get a right to sell at 1940. So if he wants to sell his Reliance shares at 1940, no matter wherever the Nifty falls, so he can buy a 1940 put option by paying a premium of 38 rupees 45. However, if he is okay to accept some loss, and if he is ready to even sell at a slightly lower price, let's say 1900, so in this case he can buy the 1900 put option. The advantage for him in that case is he need to pay a premium of 21 rupees, which is almost half of the premium what you would pay for 1940. So this is how investors can choose various strikes. So basically for call options, the more you go away from the spot, you end up paying a less premium, and the more you go deep into the option chain, you end up paying a higher price. Now let's understand this from traders point of view. So basically traders choose the strike based on their capital and the risk they want to take and the probability of winning. Now let's say a trader thinks that Reliance share price is likely to go up, and he got let's say around 10,000 rupees capital. So he got 10,000 rupees capital. So Reliance one lot is equal to 250 quantity. So now let's do some maths. So Reliance 1940 call option is trading at 40 rupees 80 paise. Okay, and one lot is equal to 250 shares. So which works out like 10,200 rupees. However, this trader has only 10,000 rupees in his hand to get into this trade. So in this case, he will not be able to buy this particular contract. So what he can do, so as options, as the name suggests, they give the multiple options for the traders to buy or sell options. So in this case, he can still take an advantage of the Reliance up move by buying a 1960 call option. So to buy a 1960 call option, so all he needs is 31 rupees 70 paise per share, which works out like a 7,925 rupees. So similarly, if somebody, if a trader thinks that Reliance price will go down, so according to his capital, he will go and choose a particular options which suits him. Apart from capital, from the probability of winning the trade by the end of the contract, so let's say a trader buys a 2000 call option by paying a premium of 17 rupees 80 paise. So what happens in this case is, unless Reliance share closes above 2017.80, which is a break even point, he will not be able to make any profit in this trade. And now let's look at, there is another trader who bought the 1940 strike price by paying a premium of 40 rupees 80 paise. So in this case, as long as Reliance closes above 1981 rupees, he will be able to make some profit. So what this means is, you pay higher premium, you get the higher probability of winning your trade, and you pay less premium, so your probability of winning your trade will be less if you are going to hold the contract till end of the contractual month. However, so if you want to take a quick profits, for example, let's say Reliance goes up by 20 rupees, so both these call options will give you some profit. And if you don't want to sit on this trade till the end of month and just book the profits whenever you see some profits, you can always do that. And both these options, any of these options, will give you that option to take quick profits out of the trade. Now let's see how this works for a option seller. Let's say a trader decides to sell 2000 call option at a premium of 17 rupees 80 paise. So when someone sells a option, he will receive the premium. Always remember, option seller receives the premium, option buyer pays the premium. Right? Now in this case, as long as Reliance is not going to close above 2000 rupees by the end of the contract, he will, this option seller keeps this entire 17 rupees 80 paise as a premium. Okay, it's as a profit. So in fact, so this option seller will not incur any loss as long as Reliance is not going to close above 2017 and 80 paise. Right? So if it closes anywhere between 2000 and 2000 rupees, he will receive this maximum profit of 17 rupees 80 paise. Now let's look at another trader. He sold 1940 call option. So in this case, this particular option seller will be able to make profit, he'll be able to make a full profit as long as Reliance is going to close at 1940 and below. But as Reliance starts going up and closes above 1940, his profit will slightly come down. In fact, so beyond 1981, he will start making losses, right? So the difference here is, so when an option seller, he chose to strike off 2000 rupees and sold the call option, and he was able to make a full profit as long as Reliance is going to close 2000 and below. But when the different option seller, when he has chosen 1940 as a strike and sold that option, so he can make the full profit only if Reliance closes at 1940. So what this means is, so from the option seller's point of view, the more longer or the more OTM options they select, their probability of winning the trades will be higher. And if they choose the at the money or in the money option contracts, so their probability of winning the trade will be less. So what are this at the money, out of the money and in the money call options? I will explain them in my next video. I believe now you understand what is strike price better and how investors and traders use various strikes according to their needs, capital requirement, risk appetite, and probability of winning the trades. If you have got any questions or doubts regarding the information and knowledge I have shared, please post your questions in the comment section below and I will respond to you at the earliest. Also check the description of this video for more information and to get access to all my live trades during the market hours. So it's an opportunity for you to trade along with me through my private telegram group. Please like and share this video if you found the knowledge and information I have shared in this video useful, and also don't forget to subscribe to my channel and click the bell icon so that you will not miss my next videos. Thank you for watching. Goodbye.